Hey guys, welcome back to my channel. If you haven't subscribed already, please hit that button. What we're going to do today is we are going to look at Purple Group. We're going to look at their balance sheet, their income statement, and their cash flow statement. So for those of you who are not familiar with this site, you can have a look at Yahoo Finance, finance.yahoo.com, and you'll see that I'm on their page. I've already typed in Purple Group. But if you are looking for a specific company, you can come to the search bar up top here and type any company that you want. And then Purple Group is the company I've chosen today. But any company you choose, you can type it in and Yahoo Finance will bring it up for you. So let's get into today's YouTube video. And what I want to show you is a few things when it comes to doing your own research. How do you start? What do you do? What are the things that you look for? So although these aren't perfect solutions to figure out if you want to invest in this company or not, but it is a good start and it can help you make better decisions. You can see that Purple Group is at 159. So that means it's at 1 Rand 59. So if you wanted to buy one share, it's going to cost you 1 Rand 59. Earlier it was on 156. So some of the numbers that I've worked with earlier were 156. So there will be a small difference between the price comparisons if you had to do it with 159 now. But I worked with 156. So let's get into it so you can see what I am talking about. So I'm on Purple Group now and I go to their financials. So I can click on their financials and you will see that there's an income statement, a balance sheet, and a cash flow. So each three of these things are important to use when you are analyzing a company or doing your research. So there's a few things that I want to point out. That Purple Group is a South African company, so all totals are going to be in ZAR, in rands. And for accounting purposes, they make the numbers smaller so that you don't have all these crazy numbers together on the balance sheet or the income statement. So when you see 207, 208, it's actually in thousands. So that is actually 207 million, 208,000. So we're going to be looking at TTM. I've mentioned this in a video before that TTM stands for trailing 12 months. So 12 months prior to now, until now, we're looking at that income, that period of time where Purple Group has brought in money. So the first thing I want to point out is their total revenue was 207 million Rand, 208,000. So that's the group revenue that they've brought in for the last 12 months or the trailing 12 months. So it seems like it's a fair amount. And just with that, you feel like, wow, the company's brought in 207 million. So that doesn't mean go and invest, because what's their return on the capital that they've spent and how much are they keeping of that revenue? So that revenue, they still have to pay wages, they still have to pay marketing fees, they still have to pay staff, which is wages, they still have to pay taxes. So all those deductions come off and eventually you're left with a net profit. So if we scroll down, we are on the income statement. So if we scroll down, we'll see net income on the balance sheet over here. If I click on it, it will tell me that they have 21,861. But now remember, that's in thousands. So their net income, their net profit is actually 21,861,000 Rand, which is fairly decent. So the group is bringing in 207 million Rand. And after they've paid all their expenses and everything that they've needed to pay, they left with 21 million Rand, 861,000. So now that's good and well. But now, how do I know if that's what they valued at a price? How do I work out true value? So there's a few accounting ratios that you can use to help you. You use this mainly to compare it to other companies in the industry, or just to compare it with other companies you might consider investing in as an alternative. It will show you which company is probably doing a little bit better or which one was worse. So let's look at the gross profit. Their gross profit is 141,837,000. So that's great. That's before wages and interest deductions and expenses like tax, and before salaries. So that's just showing you the cost of the goods relative to how much money they actually can, how much revenue they're bringing in, and the cost of goods. So how much does it cost them to make the things, and then the money that comes back after that, which is 141,000. So that excludes other costs like wages and taxes, like I mentioned before. So my gross profit margin that I want to work out for the company, I'm just going to take 141 million and I'm going to divide it by 207 million, and I'm going to get 68%, give or take. Okay, I'm rounding up and down certainly. The actual answer is 68%, 68.45%. So just for simplicity's sake, I'm just going to be speaking in round numbers to make it easier to understand. Remember, I'm not giving you financial advice. I'm just showing you the educational aspect of going about investing. So I'm not saying go and buy it. I'm just showing you how you can go about making better decisions. So we've worked out the gross profit margin by taking the gross profit margin, dividing it by the revenue. Remember, gross profit is telling you what it costs them to make the product, sell the product, and the profit they get to keep. So it doesn't include all the costs of the company. That's why it's gross, and then we have net. On the other hand, the net profit, we come to the net income, which is 21 million. And if we divide that by the total revenue, then we can get the percentage of net profit margin, which is just over 10%. You can see they've got 21 million in net profit and their total revenue is 207 million. So net profit margin of about 10%. Again, that's just a percentage. Yes, I know that. But what's it going to tell me is if I'm running my numbers, I can use the percentage and the ratio to compare it to some other company in the same industry. So I can work out, okay, Purple Group is competitive or they're not competitive to their peers. So that's what the ratio is used for, to help you identify competitiveness. Another one that I want to point out is the operating income. Here we have 50,519,000. So again, I can use a ratio to give me a percentage. If I take the operating margin and I divide it by the total revenue, then again, I'm going to get round about 24%. So percentages don't tell me much other than what I'm going to compare it to. So those are some of the things you can look out for in an income statement. All right. I'm not going to get in too much into everything else. Earnings before income tax, demortization. That's just showing you other relevant information that you can dig deeper and go into. Shows you how much income they've earned and the tax that they need to pay. So that's all on the income statement. That's the income that's coming into the business. If we go over to the balance sheet, that's now going to tell us assets and liabilities. So the total value of the company, which we can see in total assets. So Purple Group's total assets are 625,463,000. So 625,463. Their total liabilities are 299,954,000. So if I want to work out shareholders' equity, I just deduct those two amounts. I take total assets and I minus it from total liabilities, and I'm left with roughly about 325 million in shareholders' equity. All right. But now there is also minority interest, which means Purple Group itself might have a subsidiary, a company that they don't own 100% of. So if Purple Group owns 70% of that company, then who else is owning the other 30%? So Purple Group can't add that equity into their total shareholders' equity. So if you had to deduct the minority interest, you're left with 297,974,000 as shareholders' equity. All right. You can see that over here. It says total equity, gross minority interest. So once I've deducted the total assets and I've got my total assets, I've deducted my total liabilities, I'm left with total gross equity. Then I still have the gross minority interest that I need to deduct, which you can see has been broken down for us. After that, after I've deducted the minority interest, I'm left with 297 million in shareholders' equity for us shareholders. So there's an important thing to take note here. And if you look on all balance sheets, most companies, in fact, all companies have this. It's called goodwill. So it's very important because it's not a tangible asset, it's intangible, and it's sort of arbitrary number that they make up. Goodwill is sort of like your customer base, your brand value, and proprietary technology that the company owns. What that means is it's their technology that they own, and it's only theirs. So that's where they derive value from in their goodwill. So customer base, brand value, and proprietary technology. Now that's important because their total assets is 625 million. But if you look very closely, what are you going to see? You're going to see that they have current assets of 256 million. So that's cash on hand that they have that is going out, can go out within the next year. Then you also have current liabilities, which is the cash that the debt obligation that they need to take care of in the next 12 months. And if you look at Purple Group's current liabilities, it's going to tell you it's got 255 million rand. I'm just going to round it up and say 256 million that it needs to pay out in the short term. So it needs cash flow and working capital to be able to service that short-term obligation. And if you look at the balance sheet where we are under current assets, we have 256 million. So they've got enough cash on hand to service short-term liabilities, but they don't have that much. So the liquidity is all right. But if you look at the years prior to that, they've substantially grown their asset base. All right. But I'm going to come back to that point now because remember they have goodwill, which is an intangible asset. So the more customers they get, I'm referring to Easy Equities now within Purple Group, more customers equals higher brand value, which pushes their assets up. Intangible. But we'll get to that in a second. But I want to show you that working out the current ratio, you take the total current assets and you divide that by the total current liabilities. And that leaves you with 1.0007. That means they basically just have enough cash to cover their short-term obligations. And in fact, they are going to be left with about 184,000 Rand. So that's how much working capital they have. So if Easy Equities runs into a bit of financial strain or something goes wrong, there's two things that they can do. They can dilute existing shareholders by issuing more shares to raise capital to cover short-term costs. They can sell current assets that they have to get free cash flow to service short-term costs, or they can temporarily access loan facilities and add debt to the larger group's balance sheet, their group's financial statement. So they can add debt, they can sell assets, or they can dilute shareholders by issuing more shares. So a company uses all three of these things to raise capital, and each of them have a cost. So that's what a current ratio shows you. It shows you the liquidity within the company and how they're able to, you can determine, okay, they've got enough cash. Are they going to be able to handle any situation that comes their way? So that's an important thing to look at. So we've got the total assets and we've got total liabilities. So those are two important things to look at. If you look, I'm going to show you now about goodwill. So I'm looking at the total assets and total non-current assets. So net PPE stands for property, plant, and equipment. So you can see they've got about 7 million rands worth of property or plant or equipment that they own. So that's things they can sell, but not very quickly. So that's why it's not under current assets. They can't liquidate them to get cash very quickly um, to to service their short-term debt. Okay, so it will take a while for them to service that. So if the group runs into a liquidity crisis, they'll take on debt temporarily, maybe use their existing assets as collateral to get funding, and either sell those assets off to pay the debt, or believe that the debt can generate money in the short term to cover the costs of that borrowing. But here's the thing that I want to point out the most. I've mentioned it a few times now. It's goodwill and other intangible assets. So goodwill, I just explained that to you. That's the brand value. So you can't sell goodwill. I can't sell my goodwill unless I plan to sell the company. I'm putting a value on what I think my customers are worth, my proprietary technology. All right. So if you had to deduct your goodwill from your current assets, then you can see that the true value of the assets is actually much lower, because goodwill is sort of a thumbsuck. And every company might overstate what they believe they're worth to what they really are. So that's something to take into consideration, especially when you are analyzing a company and looking at their total assets and their total liabilities and working out shareholder equity. The goodwill can sort of distort what the true shareholders equity is. How I normally do it is I just minus goodwill from their total assets. So if we had to, I just want to plug in my charger, sorry about that. If we had to minus total assets, if we had to minus the goodwill from the total assets, we can take 625. I'm just going to keep it simple and use short numbers. 625, which is referring to 625 million. And I'm going to minus this 281 million goodwill. So I'm just going to minus 281. And I'm really left with a figure of 344 million in total assets. So you can see it's sort of deceiving. And I'm not saying that Purple Group is deceiving us. Don't get me wrong. This is a common practice. Companies they all have goodwill. You can go look at Sibanye, you can go look at MTN, you can go look at Naspers, you can go look at PayPal. Any company is going to have goodwill. It's just the brand value. So I wanted to point that out. So if we had to deduct the goodwill from total assets, I said we would have 344 million. Now look at the total liabilities. We have 299 million. That leaves us only with 45 million in shareholders' equity. So you have to take that into consideration. I'm not saying Easy Equities or Purple Group is not worth anything. I'm sure people would want to buy the brand. At the end of the day, as customers, we are what's giving it value. They can extract profits from us. Eventually, what they will probably do is introduce a monthly fee on their platform. So think about it. They have, I think it's roughly about 1 million people right now. If they introduced, say, a 20 Rand monthly fee, is that going to make you run away from the platform? Maybe. There's a certain number that will deter people from continuing, where it's price discovery that they need to figure that out. But in the future, Easy Equities is going to grow, more people are going to join, and they're eventually going to introduce a monthly fee. So it's not a bad thing, because that's going to increase their revenue as they grow, as they expand. So we'll look at earnings per share now and price ratios, and I'm going to come back to that point, because normally high PE companies like Purple Group, they have to grow into their earnings. So they're going to look for other ways to make money to justify their high PE ratio. So one way is charging a monthly fee. Another one is maybe offering insurance. It depends on management, and these are the things you have to look out for in the future, the years ahead, possibly even the months ahead, who knows. So we've covered the total assets, we've covered the total liabilities. Let's go on to earnings per share. So on the balance sheet, you can see at the bottom here, it has shares issued. All right. So you can see from 2017, they've been issuing more shares, 935, 935, 2017, 2018, they probably used more debt. You can see how they went from 33 million to 68 million. So yeah, they opted to use debt for expansion rather than diluting shareholders, because at that time, the share price was very low, and it would have probably deterred us from wanting to invest, because there would have been no growth. It would have stayed maybe stagnant. So maybe using debt in this instance was a smart move. But the year after, instead of using debt, they brought their debt down by 1 million, but they issued more stock. So instead of taking on debt, they decided to dilute shareholders this time. So they've used the combination of both, which is it's very smart. The problem is, it's not a problem. What you need to be looking out for is how is management using the money, where they spending it, and what the return is on that expenditure, on that capex. You can see in 2020 they diluted shares again. They increased the share ownership to expand, and they increased debt simultaneously. So they increased debt and they increased share capital. So they're either trying to grow aggressively in a new market, take on more risk, or they're just trying to raise more capital. Since 2017 to 2020, they increased their shares by 5%. So if you've been a shareholder since 2017, you've been diluted because they've issued more shares. But you've probably also enjoyed capital appreciation in that time, which is a good thing, but the stock is overvalued. Based on its financials, the stock is overvalued. Easy Equities has to continually grow to justify what their valuation is currently at. If they have one bad quarter, one bad year, you will see the stock plummet, because then they aren't reaching projected targets. They aren't growing as quickly as they expected. So you have to watch out for that. That's why when companies don't meet their projected targets, their share price tank. That could be an opportunity to grab some at a cheaper price, but it depends on management strategy and how well they can actually continue going forward. Because think of yourself when you have your own money. One month you might make a little bit more, one month you might have an extra emergency. Your child gets sick, you have to spend an extra bit of money. That doesn't mean you are bad at finances. It just means you had something unexpected happen. It's like having an emergency fund. Companies have that along the way too. So if you believe in the company's growth and where you see them in 5 years, then yeah, the price is fine, but you need to consider what could happen. So we've looked at the shares issued. We need to know the shares issued to work out earnings per share. So we go back to the income statement to work out earnings per share. We have to take the net income, which I think was 21 million. Yes. Okay. 21 million. Remember, it's actually 21,861,000, but just to make things more understandable, I'm using round numbers. So we're going to take 21 million and we have to divide that by the shares outstanding. So we know we got 21 million. We're going to take the shares outstanding, 982. Okay. Remember, I'm just working with easy numbers. So I'm going to divide that and I get a total of 0.02. So that means for every share Easy Equities has, it's earning 2 cents for its shareholders. Doesn't sound too attractive when you put it like that, compared to a peer who might be earning 4 Rand a share or 16 Rand a share. But at least it's not negative earnings. That's a positive. They've were negative earnings. You can see how they've come out of negative earnings and they're actually producing cash flow. Working capital, which you'll see on the cash flow statement shortly. Yeah, sorry, on the balance sheet, you'll see working capital. So the working capital is, remember I showed you the current ratio, short-term liabilities and current assets. Current assets, current liabilities, you deducted 2, you're left with free cash flow. So Purple Group is working with 184,000 Rand in free cash flow, working capital, which is an improvement from 2019. You can see there were 6 million Rand in the red. It means Purple Group was losing money. The year before that, they were in the positive. The year before that was 30 million. So their investment in their assets is starting to pay back. It's coming through. So will they continue that in the future to justify current price? If they can't keep that momentum going, then price will sell off in the short term, short to medium term. So that's the earnings per share, 2 cents a share. Now we're going to look return on equity. Again, you're going to take the net profit and you're going to divide it by the shareholders' equity. So the net profit is 21 million, which we knew from the income statement. And we're going to divide it by the shareholders' equity. Shareholders' equity is total assets minus total liabilities, which leaves us with 7.3%. Now you can go one step further. You can deduct your total, you can deduct goodwill from your total assets and use that 344 million that I worked out and you can divide that by the net income. Then your percentage is going to be something else. Okay, I haven't done the math. I've just worked out with the shareholders' equity, but I've left goodwill in there. Return on assets, same thing. You take the net income and you divide that by total assets. Remember, your total assets can also be different if you're going to subtract your goodwill from it. Okay, but I've left goodwill in there because that's what people do. And you get 3.49%. Whether that's good or bad depends on your research that you go into and how does it compare to its peers. So there's some key takeaways that I want us to remember. Okay. Before we do the key takeaways, I want us to actually have a look at the cash flow statement. So you can see that operating cash flow trailing 12 months, 113 million. Invested cash flow, they invested 32 million rand of their money. Now, I don't see where they've invested. I would have to go and dig deeper, go onto their homepage, see where they actually put in their capital to work. Because their investment is the capital that needs to generate them that return to bring in more cash flow positive. Financing cash flow, 14 million. That's basically anticipated earnings. So let's say Purple Group is anticipating 100 million in earnings. They can get that money through financing from the bank or from wherever, from projected cash flows. And then when those projected cash flows actually do come in, they can pay off that financing cost. In cash position, they have 188 million. Issuance of capital stock shows you that they issued 20,000 new shares. This shows you how they've been diluting every month. Sorry, not every month, every year that they've been increasing the shares. That's just to raise capital. It's not necessarily bad. Issuance of debt in the last 12 months, no debt. But they issued share capital. I remember reading a story about the old Naspers head of investment banking. I forgot his name. Maybe the shares have gone to him at a special price. It's all about raising capital, using the capital that they raise to invest. Your investment brings a return on your investment higher than, as long as you're not losing money. That's the idea. You need debt and you need dilution to expand. It depends on management strategy. And repayment of debt, you can see that they've paid, let's say, close to 4 million in debt. And they're left with free cash flow of 74 million. So it looks like they are genuinely improving. They are making progress. However, they are currently overvalued. So remember, sentiment also drives stock prices. So if there's a negative story or earnings report miss, the share is going to tank. Depends by how far and depends on who's going to step in to buy it. I am a shareholder in Purple Group. I like the company. I have a much lower purchase price than now. I've almost got 100% return. I'm sure I'm still one of the small fish. Many of you who could be watching this video have over 100%. All right. So those are some important things to look at when we're looking at a balance sheet. So I want to wrap this video up. I know it's been quite long. I hope you've actually learned something in the video, but there's just some key takeaways that I want to express to you. So Purple Group has 184,000 in working capital. They are diluting shareholders every year by increasing the shares. They are taking on debt and diluting shareholders to raise capital. Their total assets are growing, but their total liabilities are growing with that, which is as expected. And their physical assets, so the things that you can actually go touch, maybe a property or some vehicles, the building that they operate in, is actually only 16,687,000. And the important one to take note of is their goodwill, which is 281 million. That increases as more customers come in. So that's something to remember. All right, guys and girls, thank you for joining me on this video. I hope you've learned something. And if you feel like I've given you value, the only favor I ask from you is to hit that subscribe button and to share this with a friend so that we can all continue learning. So until the next video, I will see you then. So I'm going to say goodbye for now and thank you for joining me. Bye, guys.